A very smart start, 22,000. That's an excellent headline number to start off trade with, although let's see whether it sustains at that slippery level or not. What is HDFC Bank up to? What is SBI up to? They've really been the pillars of late for the index. 0.5% higher for HDFC Bank. SBI as well starts off about at 764 thereabouts. I can see some follow through come in for M&M as well. So that's the other stock which is in focus this morning. What about the OMCs? HPBP, IOC, and then of course add an ONGC as well in there. They also have been chugging along very smartly. Green ticks coming in for HPCL right now. IOC as well holding up about 0.5%, though I can see a bit of a pause come in for ONGC. That's actually down by about 1.5%. That also could be a knee-jerk reaction considering the windfall tax on diesel has been upped to now 1.5 rupees. So ONGC, Reliance, both of those sort of may see a bit of negative impact. What's Vedanta doing? What's Yes Bank doing? Vedanta, of course, after that sizable block deal yesterday, so was the case with the Yes Bank as well. Dilip Buildcon has been in focus. I want to see what Max Financial's Axis Bank, especially after that clarity, is up to. And I think Axis Bank is in the red, just mildly so actually, because they issued a statement last evening saying all approvals were taken for the Axis Max Life deal, so shouldn't be problematic. Interglobe Aviation, the Jan market share has come in above 60%. Escorts Kubota has executed a long-term wage settlement agreement with Workers' Union for 3 years, 0.5% higher for that stock as well. BL Kashyap has seen an order win of about almost 200 odd rupees or so. And then of course SBI, BOI, given the Bank of America upgrades that are now trickling in, not so much SBI, but the smaller candidates. Look at Bank of India, a gap up move there, 3.5% higher, now touching or rearing to go that 150 odd level in trade. So that's pretty much it. I don't think the screen is giving you any reason to complain.
Well, clearly above the 22,000 mark is what we've opened at, and the advanced decline is 7:1. That's the kind of broader market breadth which you are looking at. Look at how after a good set of numbers, Jyoti CNC shot back yesterday, almost a big move coming in, and today as well 4.5% move coming in on that one. Coal India yesterday was a big contributor apart from OMCs. Today too, we are looking at almost 2% up move coming in Coal India. Anything else which catches your attention, Aman?
Well, just looking at the overall construct when it comes to the broader markets, and it's pretty much neck to neck, but yet again, Ajay, it's the small cap index that's showing you that slight degree of outperformance, almost 1% if you will. And names that stand out include a Rain Industries, for instance, and NBCC, Bharat Dynamics, very active. Hindustan Copper is a buzz. You've got Reddington as well as something like a Credit Access Grameen. Those are stocks that are lighting up the screen. Very positive breadth as you highlighted. Let's find out Naresh's first trade as well. And Naresh, 22K on the Nifty at open. Small cap index holding out, breadth in our favor. What's your take and first trade that you're punching in?
So looking at a bounce back in IDFC First Bank, which is corrected 20% from the top. So that could be a stock which could go towards the 85, 88 in the short term.
Right, Vaishali, what about the first trades that you're punching in?
Well, I maintain my positive view on Punjab National Bank, and as you can see, it's really opening strong. So I maintain my positive bias. But now I would also look at some of the fertilizer stocks. So I would be now looking at GNFC.
Smaller PSU banks is where you are betting on. All right, let's take the discussion forward on fundamentals with Njay Kumar. Jakes is joining us from Prime Securities. Jakes, good morning. Thank you very much for your time this morning. We've been speaking after a long time. Jakes, you look at the global construct very carefully. This morning, CLS has come out with a note making a case that FPIs or FI flows as a percentage of GDP have been closer to 0.5%, say between FY 2014 to 2022 period. This 5-6 years, FIs have been on the lower side. Yes, in absolute terms, they've come. Now they're making a case that this number can rise to over 1% in the next few years. You also travel abroad. You have a very, very meaningful friend circle among FPIs. Are you getting a sense that they are warming up to India? Up till now, India rally has been powered by domestic retail money by a large extent. Can additional flows from FIs gather pace?
Well, the reality is that when so many people fall in love with a market, bubbles need to get created, as it were. Today, the bubble would have been created had it been everybody buying at the same time, sort of thing. The FPIs have been the contra, as I call them, to the local investors. And local investors have moved their savings allocation from about 2.5% 6 years ago to about 4.5 to 4.75% today into the markets. And this is the kind of tsunami we are seeing with SIPs coming in at about 18,000 crores or 18,500 crores per month. Given that kind of an orientation, the contra, which is the FPI selling, has continued right through. It's possible that when overseas allocations change and interest rates, the sort of the cool down in interest rates happen and greater allocation happens, it's possible then that you could have a sort of a confluence of factors coming in, maybe post elections, FPIs coming in, locals continue to buy, and there could be this kind of bubble formation where the markets could go up 10-15% in a very short period of time before valuations really become excessive in every sense of the word. Today, please understand that there are still headwinds that the Indian market is seeing. One of the headwinds, which recently has been earnings, for the first time this quarter has become some kind of tailwinds where every sector has performed and delivered way better than the expectations of the analysts. So earnings have been significantly better. Now that the earnings season is over, they've been significantly better. They will act as tailwinds. So discounting 25-26 is possible. The investment cycle is being set into place again. Therefore, there's capex additions, there's earnings that will come through higher capacities kicking in. The private sector is now stepping to the table in terms of investments along with the public sector. And to the extent that the Indian public has got more enthused and become more exuberant, almost bubble-like territory in certain very illiquid stocks or illiquid pockets. But with the FPIs also potentially able to come in as interest rates sort of either get capped or start declining in the West, I think you could have maybe a quarter or 2 quarters later a kind of a bubble-like movement in the market as, quote-unquote, everybody sort of falls in love at the same time with the Indian markets. So it's possible, and obviously the FPI flows have been at historic lows over the last, in fact, they've been negative as we've been seeing them. And to that extent, any shift in that FPI stance towards turning positive, I don't even need to overemphasize the fact how bullish that can be.
Sure. Jakes, you've given us so much food for thought, but let me pick up on the point that you were making about earnings, right? Because there's a stark disconnect. We all knew that it was a K-shaped recovery, and now it's getting magnified because what the urban focus earnings are as opposed to what rural India's suppressed earnings are, there's a clear disconnect there. What do you make of that in terms of an investment thesis?
Well, that's why if you see, for instance, a lot of the FMCG stocks aren't participating. They are direct beneficiaries or they are directly hurt if rural consumption declines. Urban consumption has been there. We've seen the credit card culture grow. People have been borrowing from the future to using credit to consume. That's an urban phenomena. Unemployment is an issue. Unemployment in various pockets. Rural employment is an issue. Rural consumption is an issue. So there are pockets of, should I say, disconnects or discordant notes in this orchestra that we're playing out about India. So from that perspective, I mean, I do believe that the markets have been rational. Those who invested largely in FMCG, sort of evergreen stocks, the levers, the HDFCs from a banking perspective. So the overall pockets have been and will continue to be under pressure. And the overall pockets have been at the receiving end of sell-offs, and they haven't participated. And that to that extent, I think the markets have been very sensible and very pragmatic in their approach. So given everything, I feel that the market reaction, it's almost like the nursery rhyme that when she was good, she was very, very good. This is about the child in the nursery rhyme. And when she was bad, she was horrid. So when people like a certain sector, they go completely overboard. And if they don't like it, they dump and move on. And that's being seen in terms of some of the evergreen favorites now not having performed for the last few years, and some of the lesser known, lesser loved, undervalued perhaps, but not these sort of fancied spaces have been at the receiving end of money. And I think that's also true that if the mass participation is in certain stocks, like everybody loved in HDFC, HDFC will not perform. And clearly everybody can't make money at the same time. And that's been frustrating to say the least for market participants. But again, flying in the face of traditional logic, you go into sectors that have a future. People thought that coal-based or thermal is going out of fashion. And those are the stocks that have done the best. I mean, Coal India is a case in point. BHEL has produced loss after loss after loss, but because of the future being what it is, it's trading at multi-year highs. NTPC has done brilliantly. So if you just take, without recommending a stock or two, if you just take some of the PSUs, which have been laggards in the past, but efficiency will come when inefficiencies get dropped off. And I think that's the way people are seeing the sales of the world, BHELs, OMCs, etc., where going forward, inefficiencies are being eliminated, capex is coming in, and the CEOs and the management and the board are being held more accountable for profit. So clearly the market's taking note of this, and surely they discount these things upfront, and no surprise in that.
Exactly, that's what playing out as far as the entire PSU pack is concerned. But Jakes, I want to talk to you about pharma space, especially the global construct which you shared with us, that large parts of Europe aging very fast. Even US is witnessing shortages of drugs is what we are picking up. In this kind of a scenario, how do Indian large pharma companies and the regulatory glare on them pan out? So many of them have moved higher. I mean, 400 is almost 1,000 on Oro, 1,500-1,600 Sun Pharma. Things have rebound from lows. Do you still find value in some of these large players?
Oh, absolutely do, because the reality is that the allocation to pharma in funds from an index perspective is still under 5%. One company accounts for 60% of that, which is Sun Pharma. Sun Pharma's market cap at 3,70,000 crores is 3 times the next person's. And there are a clutch of companies, 3-4 of them in the 1,20,000 to 1 lakh range. There is one company in the 85,000 range and a couple in the 60-70 range. For a company, for a sector which is so critical right now in so many parts of the world, not the least of them being India, with in the backdrop of things like COVID and recurring flus and multiple variants of the virus, propagating, etc. This space, to my mind, is way underinvested. So A, there is valuation comfort. B, there's under ownership. C, most funds have come in only from a tactical trading perspective. Stocks have moved up. Most of the companies here are low on debt, if not debt free. Most of them are huge cash flow generating companies, and they continue to marginally invest. So these are perfect recipes for a serious portfolio allocation that hasn't happened. And some of these actually are now benefiting from PLI, which is a move aimed at making India self-reliant on some of the key inputs for the pharma industry without being dependent on China. And they're also profitable. And the government also gives back in terms of concessions for investments made. So a combination of domestic PLI, US generics, multiple parts of the world, I think the space has just begun. Never mind the FDA glare. I think the positive side of the FDA is the FDA realizes how important India and Indian companies are. Their overdependence on China has actually been evidenced by interviews that they've done. They want to reduce. So will they take a more lenient view? I don't believe so. Will they take a quicker view in terms of audits and turnarounds? Absolutely. So most companies are now going through more audits because there are far many more approvals being sought for new drugs or new molecules, etc. Now, in terms of approvals, faster turnarounds are happening. In terms of corrective action, companies have become more responsive. So I don't believe audits are negative in any manner. Audits, in fact, indicate the heightened activity and the heightened approval seeking that these companies are doing. The response to that, both from a company perspective and the FDA perspective, is a lot more proactive. And my personal feeling is that people tend to get spooked on audits. It's like a speed breaker on a highway. You don't expect it, but they will happen. And there's absolutely nothing wrong in getting comments which you need to correct and move on. But unlike in the past, when certain large pharma companies had audit issues, import alerts or warnings which haven't been rectified for 3 years, today it's very different. Today the feedback and the turnaround is much faster. And I think that's a positive for the industry.
Jake, so where are those unloved or hated pockets in the market right now where you do see value, which everyone's not looking at right now?
Well, I think private sector banks that people had fallen in love with, the large ones quoting at 2.5, 3 times, 3.5 times book, they have fallen by the wayside. But a number of private sector banks are quoting at 1.25 times book. They become cheaper than their public sector peers. These are well-run, digitized banks. Capital adequacy is adequate. They're quick to the to change strategies. They're in both the wholesale as well as the retail, largely retail, they're granular. And there are a few banks that are available. We don't always need to look at the industry leaders, the well-known top 2 or 3 private sector banks or 5 private sector banks. So below that, the love for PSUs has kind of ignored these. And as interest rates actually either ease or stay at these levels, but with interest rates start coming in, I believe that these private sector banks will get re-rated. So I think it's a matter of time. So private sector banks is one. The second is the entire move to thermal is so aggressive. And with the minister himself putting out targets like 88 gigawatts, etc., of thermal power, you're talking about companies that are in the PSU space and in the private space where thermal and power generation, and most importantly, the entire range of power and power equipment, because there are absolute bottlenecks galore in that supply chain. So if there's a problem on transformers, where there's a problem on certain key conductors, there is an entire range of power equipment that will come in, and I think there's a whole host of mid-cap companies in that space that will be beneficiaries. People shouldn't look at, I repeat, people shouldn't look at historic numbers to take a call on this space. This space over the next decade, I think, is going to meet with dramatic investments and dramatic opportunities. So the power and power equipment is the other one. Private sector banks I talked about, pharma I talked about, OMCs I think would go in for multiple re-rating, much like the way the Coal Indias, etc. have. So I think there's, there are enough spaces in the market where you can draw comfort from. Will it be a straight line? Never is. Will it be a space that most of the spaces I'm talking about have not been approached by a large segment of the market, either because earnings have been flying in the face of logic, or they've been weighed down by the historical baggage of earnings and earnings multiple. And I think people need to shed that. So the biggest bane to my mind in the market is 30, 40 years of experience that some of us carry, 30, 35 years experience, where you need to shed that to look at the future differently. And I think that is what the market is. So whether I call it historical baggage, or I call it intellectual arrogance, or I call it, the legacy of the past, call it what you might, you can soften the blow, but you can't take away the fact, and you certainly can't take away the fact that some of us are weighed down by the past, and we need to view this market slightly differently, especially because younger, retail, more aggressive, more daredevil investors are coming in. So, I think casting that, you need to learn from the past, but you can't ignore the present. And I think therein lies the truth.
Very interesting. Jakes, thank you very much for joining us. In fact, as we speak, Glenmark commentary is also coming on your screen in flashes. Stock is up 8%. Talking of normalization of numbers by Q4. A good commentary, and that is leading. This is the second day in a row. Yesterday too, after results, stock shot up, and today again another 7.5%. Talking of PSUs, as Jakes is also talking about, this entire shift from inefficient to efficient is adding value. Hear out some more opinion which we gathered on PSUs. We'll come back.
Growth as a cycle which peaked out in September 2021, which lasted for a decade, more than like started in a rally from August 2012. And if even 20-30% of money shift from growth towards value, there will be big up move which can continue in value stock, and that's a thesis which we are playing, and I think it's a decadal call. It's not a just 1 quarter or 1 year call which we are playing out. And obviously the bigger call is value, not PSU, and within that PSU fit the bill perfectly. So it is apt for us to say and look at the changes which is happening. Okay, look at from the governance point of view, changes happening in the public sector, the capital allocation which has been a very big concern in the past, that has settling down.
Okay, let's move on. Let's talk about what else is happening in the market, and let's address some of the managements as well. We've got the management of Blue Star joining in on the show right now, Mr. B. Thiagarajan, the MD. It's been a strong quarter for them. The profit in the third quarter has nearly doubled. Let's take a bit of a flashback and what the future as well holds. Mr. Thiagarajan, great to have you on the show right now. Thank you so much for taking the time out. The IMD has clearly forecasted higher summer temperatures for 2024. Tell me, what are the initial trends that you're seeing, from your trade channels?
Good morning. It is a pleasure interacting with you as always. The last summer also began like that. From February onwards, IMD forecast was good, and we were anticipating great summer. But summer was a washout. Sorry. Post-summer, you had a great demand across the country. Festival season did extremely well, and you have seen our Q3 results. The market is doing extremely well for this category compared with many other appliances. Air conditioning industry is very happy that the demand has been good so far. We are all preparing for a great summer season, but weather is weather. So we have to look forward to a great summer season. And at the same time, we know that, spell of rain could spoil the outlook. We are keeping our fingers crossed.
Rajan, one is, this part of your business, which is actually pretty sensitive to the vagaries of weather. But what about electronics division, the EMP division? I see margins have improved in both of them. What's the outlook here? How did the business fare?
It has done extremely well. As you're aware, we are having carried forward order book of over 6,000 crores. The B2B segment across the country has been doing well. Shop, showroom, boutiques, manufacturing, data centers, infra projects such as metro, railway, and water. All the segments have been doing well. We have indicated in the interaction with the investors that there is a little bit of slowdown in order inflow, but we take it as a positive sign because there is no point in sitting with a huge order backlog. We have to execute. That's what is happening there. The execution speed has picked up, and we are busy executing quite a bit of orders across the country, specifically in the infrastructure segment, manufacturing and data centers. On the other hand, in the commercial refrigeration space, driven by ice cream and pharma segments, the demand has been robust. The business is doing well there. And this is a particular period where I have seen B2B as well as B2C segments doing extremely well. We are optimistic about closing the financial year once again on a very high note. This is where we are.
Your order book is up 24% on a year-on-year basis. Tell me, what's the revenue visibility that you have, not for 1 or 2 quarters, but say the next financial year and even beyond that?
Look, it varies from business to business. I hold a view that India is the fastest growing market for air conditioning and refrigeration at present. Quite a few studies point out that by 2050, we should overtake even China in terms of market size. The room air conditioner segment, the penetration is around 7-8%, and it is rapidly growing across the country, including tier 3, 4, 5 towns. The growth is visible. The channels are preparing for that kind of growth. We are expanding the manufacturing capacity accordingly. If you look at commercial air conditioning, that space also is a very promising segment for us. Commercial refrigeration, we are again expanding our manufacturing footprint. I would say that that a CAGR of 15% is definitely possible over a long period of around 5 year period.
Mr. Tyagarajan, morning. Wanted to also understand your outlook then in terms of the increase in adoption of a lot of the latest technologies. What
been indicating between 7 to 7.5%. In the segment 2, we have been indicating 8 to 8.5%. In terms of technology, the very first thing is connected with the energy labeling program. Once in 2 years, energy efficiency norms get upgraded, and therefore the variable refrigerant flow or the inverter technology is being adopted across air conditioning and refrigeration. The second one is connected with the refrigerant related migration for ozone depletion as well as global warming related issues. In air conditioning and refrigeration, close to around 25% of the cost is in electronics. We are fast seeing the adoption of even machine learning and artificial intelligence.
Tyagarajan, before I let you go, I heard you just mention that you were expecting the year to end on a very good note. If I look at the current quarter's number and take a broad estimation of say 9,000 odd crore on the top line for the full year, around 600 crore in EBITDA on a full year, I want to understand how are you now set up for the next year? Last 2-3 years were kind of softish in various part of the business. Is there a big delta between FY25 and 26 which you can hint towards?
Interesting question. We are in the process of finalizing our business plans for the year and the investments. As you become larger, the growth cannot be at that rate. Having said that, I think a CAGR of 15% is possible. That's what we would aim at. And also, we had stated repeatedly that we would like to grow faster than the market in quite a few segments, specifically the room air conditioners. Our market share goal is 15% market share. As of now, we will be somewhere closer to 14%. And 1% market share improvement in a highly competitive environment is a tough one. The good news is that demand is going to be great. The challenge is growing at the same time maintaining the margins. So as I indicated, 7 to 7.5% in segment 1, 8 to 8.5% in segment 2 is our aspiration. So it is not only the top line growth, it is also ensuring that we are maintaining our market share. As far as segment 1 is concerned, since it is a EPC business substantially within that, free cash flows are important. So therefore, we are not chasing market share there. We have stated that. We have to execute these jobs in a timely manner with a superior project delivery and at the same time maintain cash flows.
Excellent. No wonder. I mean, the street clearly has a wind of it and your stock is trading at 52-week highs. So clearly, some signs of times to come getting captured. Thank you very much for your time today, Mr. Tyagarajan.
Thank you very much.
That was Blue Star, very solid answer, especially on in the next few quarters. If you look at the last 1 year chart, the stock has gradually come back from 800 odd to almost the 52-week high levels of 1255. And this is the change. After a very bad patch or softish patch, the stock has rebounded very sharply. Let's go ahead and talk to Utkarsh Small Finance Bank. There's a lot of development happening at the recent listing from Banaras. Govind Singh, MD and CEO of Utkarsh Small Finance, is also joining us to talk about the numbers and the other development, the reverse merger. So let's talk about the reverse merger first, because that is of the viewers' interest. What is the need for this reverse merger with your parent company, Govind? And have you gotten the final approval by RBI yet?
Well, I think this is just a beginning of the process. So as per the regulatory requirement also, we are supposed to come to 26% the holding company or the promoting company in 15 years time. And the idea is that, the reverse merge, and that is the request we have got from the holding company, the reverse merge the holding company into the bank. So currently the holding company doesn't have any operative, you can say business lines. It is called CIC, Core Investment Company, and very small base of in terms of employee and in terms of the board base. So idea is that reverse merge into the bank, which is the operating entity. So that, and it's as I mentioned, it's a regulatory requirement also to bring down our promoter holding to 26% in 15 years time. So that's another part.
And what's the timeline then for this?
So, now you can say the legal or the regulatory process will start from here. Now they have already requested to bank board. Bank board will, look into the nitty-gritties of the proposal. So, and we have seen in recent past also some of the other banks also have gone through this process. So we have seen that takes around 12 to 15 months, process entirely getting the regulatory approval from SEBI, from Reserve Bank of India, and going to the NCLT process. So that's the broad timelines. Obviously, it can be plus minus based on how smooth the approvals are. But though we don't foresee any challenge in that, because I think, as I mentioned, two banks have already gone through that, two SAPs have already gone through the process, and the holding company doesn't have any operating activity at all. So the process should be smooth, and it should take that much time.
Right, morning. Let's also understand what about your latest when it comes to the business updates, the credit to deposit ratio as well. That is also looking a little bit elevated at about 99%. Some banks have been facing issues when it comes to liquidity to fuel their growth. So do you think that that's going to be a concern for you as well?
So it's not a concern for us. If you see our balance sheet, and even if you look at December numbers also, we are quite surplus in terms of liquidity. In fact, though deposit CD ratio is very close to 99%, but our liquidity has, in past also has come from the refinance and those long-term resources. So it's not that we are borrowing from market. In fact, we have always been a lender in market also. And even if you look at December numbers, we are 1,000 crore plus surplus money. In fact, during last 2 years, we have tried to reduce our, you can say surplus money from almost 2,000 crore to close to 1,000 crore. So we always have been quite, in terms of liquidity, we have been quite good, and there is no challenge as far as liquidity is concerned. And the high capital ratio, as well as the high reliance on refinance, which we had taken earlier. If you see our current year 9 months plan, our reliance on the wholesale term deposit has come down. It has reduced by 6.2%. Our reliance on refinance and borrowing has come down. Both have come down in absolute numbers also. And our reliance on the retail term deposit, actually, it has grown by around 46% plus year-on-year basis as on December 23. So quite comfortable as far as the liquidity part is concerned.
Utkarsh, what's the vision, say, the next 1 to 2 years from here? You're currently at 86 branches. What would you grow into?
Hello.
Yeah. Can you hear me?
Yeah, I can. Yeah, I can hear you. So
no, go ahead.
As per the current business plans, the way board has approved, we should be looking around 140 to 150 odd branches during this, you can say in 12 months time. And the branches will be both focused on the microfinance and the microbanking business, as well as the liability part, because liability franchise, building on a regular basis is very, very important for us. So last year was a year when we have opened close to 50 odd branches only. The idea was we had opened a lot many branches during last 3 years. We must see the productivity of those branches, and that's why there is a pause. I mean, that was a conscious call taken by the bank. But this year now we have, again, next phase is starting. We'll be expanding around, as I mentioned, 140 to 150 branches in coming in the current financial year. When I say current financial year, means next 12 months time from here.
Okay, Govind, how much growth are you witnessing in your legacy branches right now, and by when? How much time would you take for the new branches to start yielding good? First break even, then start actually contributing to numbers.
Yeah. So almost, I'll use the word around 80 to 85% growth comes from the legacy branches only. New branches contribute maybe in the range of 15% or so in one to 1.5 years time. Typically for a bank branch, if I'm looking for a general banking branches which are put up in the metro and urban area, it typically takes around 18 months, 24 months to break even when they reach around 30 to 40 crore in terms of retail deposit base. For our micro banking branches, we have a different model, and there I think we reach break even much faster. It's around you can say 9 to 12 months time when we are able to reach break even, and that's why I think all the ratios you'll see that for Utkarsh look much better. So in terms of, there is no stress on the balance sheet or on the P&L because of opening of new branches, because almost 2/3 of branches break even in the first year of operation itself.
Okay, that's your outlook. And what about your internal target in terms of your secured portfolio as it's growing on a year-on-year basis, now at about from 28% to now about 35%?
So if you look at December, we are already around 30. Yeah, we are around 35%, and we expect that if you look at 2 to 3 years horizon from here, it should up by another 10% or so. So maybe in the range of 54. Around 44-45% should be our secured book when we are looking 3 years from here. That is what we have been discussing with the investors also.
Visibility, on business front for a 30 plus kind of a growth for the next 3 to 5 year period. Is it comfortable? Do you have comfortable visibility that period?
So I think 5 years is a little longest. I think
Okay.
I'll take that 2 to 3 years is the time for horizon for which we can expect around 30% growth, on a regular basis. And I think I want to just touch upon that, the type of, especially our core geography, which is places like Uttar Pradesh and adjoining states, where we are seeing a lot of activity happening, and the type of growth we are seeing in these pockets, that will also fuel the growth, you can say. We being sort of local banks, when we are talking Uttar Pradesh and adjoining states, that is also helping us in a big way. And we do see that 30% growth should not be a problem for a bank our size, with the type of verticals we have created, the type of network we have got currently, and the type of interior, the network we have got in the deep interior in Uttar Pradesh and adjoining states of the country.
Of course, you have, and that's what is actually doing the trick. 85% of your legacy branches doing bulk of the heavy lifting, and that's where visibility of 30% for the next 3 years is coming from. Govind, great to have you. Thanks so much for your time.
Thank you very much.
That was Govind Singh of Utkarsh Small Finance. But Anisha is here now to talk about a very important commentary which is coming from Glenmark. Glenmark came out with the results yesterday. The stock ran up 7% yesterday. Today's 10% is incremental on top of that, not only on the numbers, but from the commentary. Anisha, what exactly is the management talking about, which is sparking away the stock like that?
Oh, well, yes, at the bottom line, when the company reported numbers, there was a huge loss, and that had the street a bit concerned. But then the clarification coming in from the management and the commentary in the con call today is allaying all that fear. Plus, they're talking about significant improvement in profitability going forward, and that's the reason that stock is soaring away. Q3, of course, they said is a one-off impact, and barring that, there would have been a growth of around 9%. Going forward in Q4, they're expecting normalization of business, which means that the run rate will turn back to around 1,000 crores. And that is the positive that the street is liking, that it was only a 1 quarter impact on account of the restructuring of the distribution channels, and it will come back to normalcy. India business is expected to sustain a growth of around 10 to 12%. So that's another positive coming in. And the restructuring that they have taken and a lot of other levers like Reatlas, etc. is expected to aid the margins going forward. They're talking about significant margin improvement in FY25 itself, and from there on as well, they're expecting the margins to consistently improve from there on. They're talking about how there was a lot of R&D spend that they did, almost $75 to $80 million. That's expected to come down to $45 to $50 million, and that entire saving of the research and development costs will clearly flow into EBITDA, and that will bump up the margins as well going forward. In terms of the other details, they're very confident about improving their market share in a lot of drugs, whether therapy drugs or the secondary sales market. That's a very confident commentary coming in. They already have 5 injectable products which have been commercialized, and they're expecting the full impact of that to actually come into Q4. A couple of other important lines as far as North America business is concerned. They're expecting a revival of North America business from Q4 onwards, and there's an important respiratory therapy drug that they have been working on, and they're expecting a contribution of almost $80 million from that single drug itself, which will happen in FY25. And they're saying in the con call that this drug comes at a very high margin. So that's another lever for margin improvement, and I think that is what the street really likes, that there'll be a turnaround in the business, especially when it comes to the profitability and margins, and clearly the stock is excited.
Yeah, excited. It sure is. For a second day now, 8% higher and decent set of volumes as well. Almost 3 million shares traded already on the stock price. I'm sure it's higher than its 5 and 10-day averages too. But let's move on and let me welcome on board Sunil Bora, EDN Group CFO at Uno Minda, joining in on the show right now. Sunil, hi, morning. Good to have you on ET now. Just going through your Q3 performance, and we've seen a 20% growth in your top line. You've given a good guidance as well for the coming quarters. What segments make you confident and you think will contribute to growth?
Yeah, hi Aisha. So there are a lot of segments, we have been first of all agnostic to IC or EV engines. So there are a lot of products which are driving the premiumization wave, or there are a lot of components from the EV perspective which we have launched and we are the market leaders in the country, which are seeing a good traction. If you have to name some products which are seeing a very good growth, and we do expect it to continue for next 5 to 10 years, is your alloy wheels for pass cars, seeing significant adoption rates. When we entered this business 5, 7 years back, it was 17%. Today it is close to 45, 50%, and globally it is almost 90, 95%. So alloy wheel business will continue to grow. The second business which is seeing significant growth is our lighting business, specifically again for PV segment. We are seeing significant growth there, coupled with the market share gains and also the premiumization. We're moving from halogen to LED. The kit value is increasing significantly, for almost like 3 to 4x of what it has been. Then there are a lot of other sunrise products like wireless chargers, or even exports wise, the switching and seating are doing phenomenally well. From EV perspective, the business are doing pretty well. So there are a lot of factors which are riding on this, and we are pretty confident that what we have delivered in last few years, we should be able to continue that for next many years to come.
Sunil, you're talking about confident visibility next 5 to 10 years from now. Do you have that kind of order pipeline already, or at least visibility on the same, to be so confident about your numbers?
Absolutely, Aisha. So what gives us confidence is the business we are in. You know that whatever business starts today, or whatever business you get today, starts with 1 or 2 years forward in terms of development cycle, and it links to the launch of the vehicle of the OEM, and then the product cycle is like 4 to 5 years. So obviously the joker in the pack, or the only variable factor, is the industry volume, which is not in our hand. And that's why we never give guidance on revenues. But we are pretty confident based on the businesses we have been securing. We are confident of gaining our share of business. We are confident in terms of our new products. We are confident in terms of new expansions. We have been working aggressively on expansions. There are like 8, 9 projects which are currently under construction phase. So next few years, we are very, very confident of our growth. Obviously, volume is something which we can't comment on. But as we always say, for long term, we are our target is minimum to give at least 1.5x of the industry growth. If you see historically, we have done much more than that. But maybe one can say conservative. But I think that's the long term goal we have. We don't look at quarter to quarter. Definitely, we see on a year to year basis, and the guidance which we have given, we're pretty confident of 1.5x industry growth. At least we should be able to deliver in medium to long term.
Mr. Bothra, I was just looking at the commentary coming from your side, from the management side in the conference call. And what excited me is that, one, your overall margins are actually, the trajectory is going higher, because obviously the product mix is changing. And you are, of course, plowing in a lot of cash flow to your capex. Are you telling me that in the next 4-5 year period, your, say, 14,000-15,000 crore top line, almost 1,500 crore EBITDA kind of run rate could, completely change a whole lot? Because bulk of your new initiatives towards the new products, etc., will actually come in year 3, year 4, year 5. Where can it change the complexion of your company to then?
Oh, it can significantly change the complexion, as I said. First of all, while we don't comment on volumes, we are pretty confident of the long-term growth of the country. There are various forecasts. People say that the India PV market, which is currently 4 million market, will grow to 7 to 8 million market in next 7-8 years, right? Or the 2 million market, which is 17 million, will go to 30 million two-wheeler market. So definitely quarter on quarter is very difficult to comment. There are both sides of the story in terms of next year's growth. But if you see long term, we are in a long term bull cycle in terms of industry penetration, right? If you see the adoption itself, the pass car adoption in India versus some of the other developing countries versus developed, we are a fraction of that. So there is a huge potential to grow. And with that potential in mind, we know that while we have multiple facilities in India, we have been running almost close to capacities, and we have been working to get land in advance. We are working with the government to see how we can get the incentives under the mega policies, etc. So we actually just bought a 86 acre of land in Pune. We just bought around 37 acre of land in south in Krishnagiri district near Hosur. We are in process of getting 95 acre of land allotment in Haryana from HSIDC. So we are working very, very aggressively to see that the next phase of growth, we should be able to capitalize in a timely manner. We know we had some hurdles in past in terms of getting land on time. So we are preparing well in advance to capitalize on the long-term growth trajectory as we move ahead. In terms of products also, not only industry volumes, we are seeing a lot of premiumization where if I have to take one or two examples, I just took like the wheel size today was 14 to 15 inches wheel. Now, when you move to SUV, the wheel itself will grow to 17 to 18 to 19 inches wheel. So that itself sort of gives you a 40-50% growth in the kit value. Then the number of cars are increasing, then penetration increasing, then there is export traction. There are multiple factors which gives us confidence that we should be able to deliver what we have been communicating on.
So can we then assume that even when it comes to your overall margins, that will head to about 12 to 13%?
So definitely in long term, that is our endeavor. So in short term, you know that we said this year our guidance was around 11%, and we are in line with that. Hopefully this year we will be able to meet or maybe do marginally better than that on a full year basis. Our next year guidance also is in line with that. In medium to long term, yes, we do expect some operating leverage to kick in because initially, as you will appreciate, we are in a phase of expansion. We will have another 8-10 plants getting commissioned in next 12 to 18 months. So initially, those new plants definitely don't add to your accumulate to your profitability. In fact, they are a bit of a drag, which our standard cycle is we see third year of operations where we expect the plants to deliver the normal profitability. So because of which that all is baked in, we are saying in short term, maybe a year or two, maybe with around 11.5% in a couple of years, and then maybe definitely we target to move north with the advantage of operating leverage as the revenue continues to grow.
All right. Thanks very much for your time, Mr. Bothra. That was Minda talking about the numbers this quarter and how gradually there could be a hockey stick kind of a shape where the numbers could actually catapult over 18-month period. That's the Intero Healthcare listing which is happening, soft listing, 1% below the issue price. It's a peer of MedPlus, the healthcare distributing company. In the last 3-4 years, the numbers have been slightly on the softer side. If indeed their numbers improve in the next 2-3 quarters or the years, then the valuation would appear cheap. But right now, by solely looking at the numbers which have come in the past, it may appear slightly steep on valuations. That's the Intero Healthcare listing for you. But moving on, HOEC, in fact, a lot of oil exploration companies have been in focus. This one in particular is based out of Northeast, Assam in particular. Ramaswamy Jeevanandam, he's the managing director of HOEC, who's joining us now to talk more about the third quarter numbers. Thanks very much, sir, for joining us. Your third quarter marked the first takeoff of crude from B80 oil well. Could you explain to us and also the logic behind the sale happening only when inventory crosses the 4 lakh barrel mark? Because given that your daily production rate is 800 barrels per day, it will take 500 days for the next sale to happen.
Yes, if 800 barrel is the only production, that is, you are right, it will take 500 days. The minimum parcel size required by the refineries are in the order of 400,000 barrels plus. So this is a storage of crude oil at FSO. It will the shuttle tanker takes the crude from the FSO. So that's why the minimum parcel size is 400,000 barrels. So in our case, we are waiting the D1 activation. If that is successful, then this duration of 500 days would come down. We have to wait for the results of the backer operations to be carried out in the month end and early next, the first week of March.
Right. Well, I just wanted to understand also how the pricing works for the same. Suppose you supply something today and then that gets sold after 500 days.
That's a simple process actually. The month of average price of the Brent price for the month of offtake would be the basis for it. Suppose I make an offtake on 30th of January. January Brent price average would be the basis for pricing.
Okay. Now the DWell clearing work has been ongoing. When will this be done, and when will the field be ramped up as per your estimates?
See, this is a reservoir blockage on one well because the field is having only two wells. That's why it becomes predominant. And we believe in the value of the block, the underlying reserves in the block. So we plan to drill 3 wells also in 26-27. So we are confident that this field will back to its full potential. But now we are bogged down with the shutting down of the D1 well.
Right, Mr. Jeevanandam, so say for the first quarter FY25, are you confident that both the wells will be operational, these important ones, and what would be your overall oil and gas production run rate by then?
It is in this business, giving a guidance is inappropriate. But everything goes well. You can't say that. You better not to give any guidance at this stage for the T1 well, unless the backer operation is completed. Otherwise, our current production level will continue.
Right. Currently, your debt stands at about 150 crore rupees, but you have planned capex of 1,000 crores for the next 3 years. How do you intend to fund it?
You could have seen our EBITDA of 9 months, and we will be crossing 300 crores per annum, our net cash. So with that, we will comfortably able to meet our all discretionary capital expenditure of 1,000 crores. And the debt obligation is over a period of 3 years, 3 to 4 years. So it's not a big burden to us, 150 crores. So we will be able to meet all our capex with internal accruals itself.
Any kind of production guidance that you can give us regarding the Dirok fields?
I can tell you one thing, it is inappropriate in this business to give any guidance because many of the imponderables are there, many variables are beyond our control. But our wishful projection is to double it our current production, that is our wishful projection. And our reference goes to 60%. We are planning the gap at the moment, planning for the gap as such.
Right. Okay. So the two main pipelines of yours working in Northeast Indradhanush gas grid and GAIL Urja Ganga, by when are they expected to be completed, and how do you see the demand to shape post the same?
See that I can't comment on the completion dates as such. Once it get completed, even the DNPL line get connected and hooked up to the from Duliajan hub to the IGGL line, we should be able to ramp up at least 40 million cubic feet of gas per day. And if the Northeastern gas is getting connected to the national grid, we are ready to ramp up to 70 million cubic feet per day. That would be the field production.
Sure. And from FY25 onwards, full potential you think of Dirok field can be realized, and how much could that be?
Yes, I told you it is inappropriate to give guidance, but if everything goes well, we could be able to ramp up next financial year at least 40 million cubic feet of gas. And next but 1 year, when the entire gas grid get connected, when the gas from eastern region can get into the national grid, we are ready to ramp up to 70 million cubic feet per day.
Right. In the recent budget, we have seen a special importance has been given to the Northeast region. In fact, Finance Minister did mention it as a key focus area. Given that you have a very significant presence there, what kind of developments do you see over the next 2-3 years?
See, it's a substantial work is happening on it. This gas grid itself is a big move. So once there about 8 to 10 million, 12 to 13 million cubic meters of gas gets into the national grid itself is a big movement in the Northeast region. And that itself is creating a substantial value and revenue to the area itself.
All right, Mr. Jeevanandam, thank you very much for joining us on the show today. We'll take a short break on that note, but also to let you know that this afternoon we're going to put out a very important show on PSUs. PSUs, is the rally over or much more steam left even from current levels? At 2 o'clock, a lot of ministers whom we interacted with, along with some managements and market participants with a very clear opinion on PSUs, would be joining us on that show. Do track it.